Okay, here we go. It's Sunday. And this morning when I turn on my computer, this video came up in my YouTube feed. And have you ever seen this guy? This guy's crazy. He builds these like rocket powered go-karts. He's out there flying around the Mojave Desert or somewhere, filming himself with the GoPro. Check this out. Check out those engines. Like they're getting so hot, they're turning red. Oh my God, look at this thing. Look at this. This thing is flaming. And when I saw this guy reminded me of, sort of looks like he could be the real life Mad Max Fury Road. He's like right out of that, which then made me think of Fury Road, the Fury Road trade, the 112. Then it made me think how the 112 trade could be a lot like this vehicle here, like a totally unsafe death trap. And then finally it made me think how I get a bad feeling about how this poor guy's going to end. And then that made me think about all those 112 traders out there and how I hope the same sort of thing doesn't happen to them. Which brings me to today's video on the 112. Now, a couple months back, I made a video on the 112 trade and the things that bothered me about it. And I'll leave a link. Like if you look up in the right-hand corner, I'll try to leave a link up there. You can go back and watch that one. I really break it down step-by-step detail and what I see as the major flaw or problem with that trade. And I'll also leave a link in the description for it. But anyway, these videos got me thinking, I haven't done an update on the 112 trade. So I thought today I'd do that. I'd do an update, see how these trades would have performed over the last couple of weeks. So that's what I'm going to do in this video. So I'm just going to do a back test. There's this really cool feature on Thinkorswim called On Demand. And I also did a video on how to use that. But basically what the On Demand does is if you click on this right here where it says On Demand, it enters you into this like virtual account. So the account looks exactly like it does with Thinkorswim, except this is like a fake account and you can put fake money in there. Like what they've done is they've gone back, they've recorded all this stock market data going back years and years. So you can go back, you can pinpoint any day and time of the day that you want, go back in time, go back to that day, and you can see what the stock market's doing on that day as if it were a live trade on. You can see it tick by tick and you can place trades on it as well and then monitor them through the risk graph, and it's like back testing. It's a really, really cool feature. So what I'm going to do today is I'm going to come in here into On Demand and we'll just do a back test of the 112 trade and see how it would perform and then compare it to a simple hedge that I referred to in the last video I made on this, as well as my preferred strategy, which is similar to the 112, but it has a built-in hedge to it. And in my opinion, it's a much superior trade. So I'm just going to do a back test on each of those and then compare them. I'll do it right here live so you can see the whole process. And let's start with, let's go back to, let's see. So let's go back to 319. So let's just start. We'll start each test on the same date. Let's go to 319, and we'll pick the same time for each one, which let's just say 12 o'clock, like an hour before the market closes, and we'll hit go, and this will take us back to that time. Okay, so here's the chart of the SPX. This is as if we just went back in time, and we're on this date. We're on 319 right now, March 19th, 12 o'clock. 1 hour left in the market, and this will be our starting point for each of these tests. So real quickly, I'm just going to throw on a 112 trade, like a standard 112. Here's the trade right here, and here's our current position. You can see right here, it's like 38 cents profit, so it's basically break even. So let's just act as if we just put this trade on. And then all we do is to back test it, we can just come up here to the date and we can go to the date or time. So for this test, I'm just going to go to the end of each week. So we'll kind of like see how it performs week by week. So I'll go to Friday, the 22nd. We put this trade on in the back tester on the 19th. So we'll go to Friday, the 22nd, and I'll just leave the time the same just to keep it simple. So this will be Friday, the 22nd at 12. So we'll hit go and we'll see where this position would be at. So you can see up here it says pre-buffering, so it's like it's going back and finding all that data for that time frame. And then as soon as it stops, so now it says pause. So now it's found that time frame, and here's where the position exists. So on Friday, a couple days after we put this trade on, Friday at noon Pacific Coast time, this trade is up $136. Okay, so let's go to the next one. And we're just going to go week by week. So that was the 22nd. So let's go to the next Friday. But this was a holiday. I think this was Good Friday. So let's go to the 28th. So we'll go to the 28th, March 28th. We'll keep the time the same, and we'll say go. So there it is, pre-buffering. It's finding all that data, and then in a few seconds it'll find it, and we'll see where the position existed on that date. Okay. It's done pre-buffering. So it's saying on that date, this position is basically at break even. It's down $12. That's not too bad. And let's take a look at the chart to see what we've been doing since then. So here's the chart we entered right here. And here's where we're currently at on 3/28 at 12 p.m. Pacific Coast time. So we're at basically, and again, at this time on this date, this position it's down $12, but we let's just say break even. So then let's go to the next date. So the next date will be April, the next Friday. We're just doing week by week here. We'll go to April 5th, the first Friday in April, same time, 12. We'll say go. Okay, so here we are on April 5th. So the position is down $1,250, $1,250 loss is showing on it. Let's take a look at the chart. So we had this big down move here, and then on Friday we came back up. So currently this position on April 5th is down let's say $1,229, $1,229. All right, so then let's go to the next Friday. So we'll go with 1 week forward to the 12th, April 12th at 12. We'll say go. Okay, so here's where we're at now. On April 12th, this position is down 2,450. Let's take a look at the chart. So you can see this, so just sort of continue to move down. And volatility is at, the VIX right here you can see is at 18. Volatility is up from where it was, but it hasn't really, 18 is not that high. We haven't seen a big volatility event at all, but it is higher than it was. And with these trades, part of what's causing this loss is the Vega on this trade. You can see the Vega's at minus 673, which basically means that each point in the volatility goes up, and the volatility spikes when the market goes down usually. So this is saying with a minus 673.60 Vega, this position is going to lose $673 per point of volatility rising just from the volatility alone. So that's the main problem with this trade. The main problem that I have with this trade is that we're naked, totally exposed to the downside, and we have this big huge Vega here that's like when volatility goes up, not only are we going to get hurt on a down move, you can see that pink line, when it goes down we're going to get hurt on that from just the price action, but also volatility is going to rise up and we're going to get killed on volatility at the same time. It's like a double whammy. So anyway, let's go back to our back test. So this is the 12th. So now we're going to go to the 19th. So this is just like last Friday. This was 2 days ago. So let's click on the 19th, same time frame. We'll say go. Okay, so here we are. This is on the April 19th at 12. Just a couple days ago, you can see this position would be down 3,712. And the chart looks like this. So we're starting to have a nice down move here. So you can see that with this trade, the downside is a problem, and it's because of this naked put, and it's because of this Vega. Look at the Vega now, it's minus 908, which means each point volatility goes up. This position will lose $908. Even if it just were to stay right here and volatility went up, this pink line would sink. And you can get an idea of that. Let's look at the VIX real quick. So the VIX is at 19, which is a little higher than it was, but it's still, 19 is not a high VIX. The VIX has a lot more room it can spike up to, like in a down move. And if it were to spike up, let's just take a quick look at, we can add volatility right here to get an idea of what the spike in volatility would do. So let's just say volatility went up by 10%, which is not a lot. That's super conservative. So we're already down 3,712. Now, if volatility were to go up, say, by 10%, you can see that this pink line, that's where we're currently at, it's come down to 14,599. That's just from the volatility going up 10%, which again isn't a lot. Let's see if we go up to 20%. 20% spike in volatility. The pink line is now down at 27,913. So that's not cool. So again, with this 112 trade, not only do we get hurt on the price movement, the down move, but we get killed on the volatility going up. Look at the volatility of the Vega now, it's 1393. And if you look at a chart of the SPX, this move may not be over. It looks like, look at this run up here we've had. We have a long way we could still drop. This thing could just be getting started. Maybe not. It could turn around and head back up again. But if you look here, you can see there's a lot of shelves where it could come down to. The VIX is still low, and usually on a correction, the VIX, I would expect the VIX to pop up higher than where it's at now. So this bear party could just be getting going. This could be like a bigger correction just getting started, which would cause some major thunderstorms for a lot of 112s out there. So that is a perfect, this is the real life example of why I don't like these trades, or what bothers me about these trades. I like everything else about them. I think it's a really cool concept. And I think that this trade can still be traded if you just add a hedge in there. In my last video about this, like a month or two ago, I was talking about just a super simple hedge you can add to this trade. And let's take a look at that. Let's take a look at adding that simple, like a ridiculously simple hedge, not even a great hedge. We'll add that and we'll do the same back test. So let me back up here. Let's take the volatility back to 0. And then let's go back to our starting date. Again, we'll have the exact same starting date for this comparison back test. So we'll go back to the exact same date, exact same time, and we'll put on the exact same trade, the exact same 112 trade, except this time I'll add in my ridiculous little hedge that I talked about in a previous video. So here we go, March 19th, it's 12 p.m., exact same time. Let's go back to the Analyze tab, and I'll add in my hedge here. And again, this isn't even a great hedge. This is like a minimum. And there's way better hedges you can put on this trade. And there's way better trades, in my opinion. There's a trade that I call the grail trade. It's my main bread and butter strategy. And we'll back test that next during this exact same time frame. But I think that strategy is head and shoulders better than this one. And again, just because it has a built-in hedge and we don't have that naked downside. So anyway, so for this test, this is the exact same 112 trade that we just back tested, just with minimum simple hedge embedded into it. So we'll do the exact same thing. We'll just move to, we'll go to every Friday. So let's go up to Friday the 22nd at 12 p.m. Pacific Coast time. Okay, so here we are on March 22nd. This position, this is with the hedge. So again, this is the exact same identical 112 trade, just with that simple hedge embedded into it. And so on Friday the 22nd, we're showing a profit of $241. So let's go to the next week. We'll go to the 28th. The 29th was a holiday, I think, Good Friday. So we'll go to 28th, Thursday the 28th at the exact same time, 12 p.m. Pacific Coast time. We'll say go. Okay, so here we are on this date, on again, March 28th at 12 p.m. This position, this is the exact same 112 trade we just back tested, except this one has a hedge embedded into it. And this trade is showing a profit of $348. So let's go to the next Friday, which will be April. It'll be the first Friday in April, April 5th. So we'll say April 5th, same exact time, 12 p.m. Pacific Coast time. We'll say go. Then we'll see where this takes us. Okay, here we are. This is April 5th at 12. You can see the position. This position is down. It's about down $22. $22 on April 5th. Let's take a look at the chart real quick. So here we are with the chart, exactly as before. We have this big down day, and it's just sort of stagnating around in there. All right, let's go back to our back test here. So on April 5th, this position is down about $20. So let's go to the next Friday, April 12th at 12 p.m. Let's see what that gives us. Okay, here we go. This is on April 12th at 12 p.m. This position is now, it's up $601. And let's take a look at the chart. So here's the chart on that date, just as before. And again, this is the exact same 112 trade that we back tested a minute ago, except there's just one really super ridiculous little hedge embedded into it. And right now the position is up $604. So let's go to the next date. This is the 19th, just the last Friday, a few days ago. So let's say the 19th at 12 p.m. See what that gives us. Okay, here we go. This is April 19th at 12. You can see the position is up $1,653. So that's a huge difference. So again, this is the exact same 112 trade that we were just looking at. We just back tested, where we had a significant loss. I think it was like in the $3,000 and something range. But just by embedding a simple little hedge into this thing at the beginning, you can see that there's no loss here whatsoever. We're up $1,653. So let's do one more test. Let's do the grail trade. So the trade that I prefer over the 112, and again, I'm not trying to bash the 112. I'm just trying to point out that there's a potentially serious issue with that thing, with the naked downside, that it's kind of like, I feel like I'm the kid in the Emperor's New Clothes who's like yelling from the side of the street, like, he doesn't have any clothes on, he's naked. And everyone thinks I'm nuts. But this is like a real life example that we're looking at, what I'm worried about with the 112, and why I don't like to, why I don't want to trade that. Why I want to trade it with either a hedge on it, or just my preferred strategy is a trade that's very similar to the 112. I call it the grail trade. It's my main bread and butter strategy. And let's do a back test of that one now. So let me clear these out. All right, and then now for the final test, let's do the what I call the grail trade. This is the trade that I prefer over the 112. It's similar, but in my opinion, better. There's a built-in hedge to it. It's way more stable. It can kick out profits super quick, and it's just the trade that I prefer to trade over the 112. And again, I'm not trying to bash the 112. It's just that downside hedge. If we can fix that hedge, even by a simple adjustment, even by like a simple hedge, like I just showed in the last back test, you can see that made a huge difference. And that was just like a super simple hedge. This trade, the grail, is kind of like the creme de la creme. This is my main bread and butter strategy that I trade. So let's back test this and compare it to the other two. This is on, let's go to the same date, March 19th, 12 p.m. Everything exactly the same. Starting date the same and the time. So here we are at the starting time frame right here. This is showing like down $11, but this is just the initiation of the trade. So let's go to the next Friday, which is the 22nd right here. So March 22nd at 12 p.m. Pacific Coast time. Let's see where this takes us. Okay, so here we go. This is March 22nd at 12 p.m. And this trade is showing a profit of $420. And if you look at the Vega, take a look at the Vega here. So this is like one of the huge differences with this trade and why I prefer this trade. The Vega is, it's not negative. It's a little bit positive, but as the trade progresses and goes on, usually the Vega will continue to grow bigger and bigger and bigger, which in a crash is ideal. You want to be in a position that can benefit from a pop in volatility if there's a crash going on. So let's go to the next date. This is, let's go to March 28th. Again, 29th is the Friday, but the market was closed. I think Good Friday. So we'll go to the 28th, March 28th, 12 p.m., exactly the same as before. Okay, and here we go. This is March 28th at 12 p.m., and this position is up $50 or so. And if you look at the Vega, you can see the Vega has continued to increase. The Vega is increasing as this trade progresses, which is really cool. So let's go to the next one. Let's go to the first Friday in April, April 5th, same time. Okay, so on April 5th, the position is showing a profit of, let's say, $31. So we're still profitable. Let's go to the 12th, April 12th, Friday, April 12th at 12 p.m. It's the exact same time as before. Okay, here it is, April 12th at 12 p.m. You can see that the position is now up $1,000, $1,002.72. So we have a nice profit going on here now. Let's go to the last one. This is last Friday, just a couple days ago, April 19th. So we'll say April 19th at 12 p.m. exactly as before in the other back tests. All right, here we go. This is April 19th at 12 p.m. And now you can see that the position is up $3,575. So that's a $3,575 profit compared to the 112, I think, was down like $3,000, $3,000 and some odd dollars. So this is a reason why I prefer this trade. This trade can make money in both up, down, and sideways markets. It's super robust, has a built-in hedge. You can get a positive Vega on it, which is a huge deal, especially when the market's crashing and volatility is going up. And these can kick out profits super fast. Like, it's not uncommon for this to hit profit target in just a matter of days. And that just has to do with how the thing is built. So anyway, this is why I prefer the Grail trade over the 112 and why it's my main bread and butter trade. So if you'd like to learn more about this way of trading or how to hedge a 112 trade, just reach out to me. Either leave a comment in the comment section below or email me at my website and I can introduce you to the group where I learned this trade. It's a super cool group, super cool community. I've been trading and taking courses for like 20 years now. And this particular group is the creme de la creme. It's head and shoulders above anything else that's out there. And this is just the tip of the iceberg. This is just one of the strategies that they have. They have a whole collection of strategies and methods and techniques for hedging and creating black swan hedges and tons of other cool stuff. So if you'd like to learn more about this way of trading, this Grail trade that I do, or even a super simple way just to hedge the 112, just reach out to me. You can email me. The easiest way to email me is just to go to my website. I'll leave a link to my website in the description below. Head on over there, sign up for my free email newsletter. As soon as you sign up for that, you'll get a welcome email from me. Just reply back to that welcome email and I see all those and I'll get back to you and we'll go from there. And in case you missed my previous video, about a couple months back, I did a little series of videos on this trade, the 112 trade, and what bothers me about it and other ways to trade it. So if you haven't seen those, I'll leave those links in the description as well. Check those out. And if you'd like to learn more about this way of trading, go over to my website. I'll leave a link to my website in the description below. Head on over there, sign up for my free email newsletter. As soon as you do that, you'll get a welcome email from me. Reply back to that welcome email and I'll get back to you and we'll go from there. All right, so that's it for this one. See you next time.